$18.97.
Yeah, that is a number that likely ruined a few breakfasts yesterday morning.
I mean, we're just putting it mildly, I think. If you are a SoFi shareholder, or honestly, just anyone keeping a close eye on the fintech space, yesterday felt, well, it felt like a punch to the gut. The stock closed down 1.23%. It hit lower lows. You look at that chart, and it looks like a massive stumble. It really looks like the bears are taking a victory lap and the sky is falling.
It certainly feels that way when you're just staring at the red numbers on the screen. It triggers that immediate, that fight or flight mechanism kicking in.
Exactly.
Yeah.
But, and here's where it gets really interesting for us today. We have a source that suggests looking at that red number is basically looking at a mirage.
Right.
They are arguing there was a massive difference between price action, what the ticker says right now, and value, or what the company is actually worth.
And that is really the core tension of our deep dive today. We are unpacking a detailed market analysis titled The SOFI Pivot. And the mission here is to decode the noise. The source is making a pretty bold argument that despite this roller coaster of fear we are seeing in the broader market, there are hidden bullish signals screaming to be heard.
You just have to know where to look.
Right, you have to know where to look. It's about critical thinking, separating emotional market reactions from data-driven fundamentals.
And we are not just talking about gut feelings here or offering hopium. We are talking about specific data points. We're going to look at something called power hour buying. We're looking at institutional behavior that contradicts the scary headlines, and a potential pivot in company strategy, specifically buybacks, that could change the math entirely.
The author is essentially asking us to step back, to spot the actual signal inside a whole lot of macro noise.
So let's dive right into that noise.
Yeah.
Because there was a lot of it yesterday. The source lists a few specific external pressures that made the market so jittery. First off, we had the geopolitical tensions ramping up in Iran.
Yeah, uncertainty is always the market's worst enemy. When headlines like that flash, risk assets, tech, fintech, growth stocks, they are the first things to get sold off.
And then on the corporate side, we had Walmart. The retail giant gave some future guidance that was, let's just call it, underwhelming.
Which acts as a huge bellwether for consumer spending. If Walmart is being cautious, the market immediately starts to worry that the consumer is tapping out. And if the consumer taps out, fintech lending slows down. It becomes this domino effect in the market narrative.
But then we got the economic data dump. And this is where I really want to break it down because it feels completely backwards if you just look at it on the surface. We got the initial jobless claims report. The forecast was for 229,000 claims.
Yeah.
But the actual number came in at 206,000.
Significantly lower than expected.
Right. And manufacturing data showed strong expansion. So let's just pause for a second. Fewer people are losing their jobs. Manufacturing is booming. In the real world, isn't that fantastic news? Why did the market completely freak out over a strong economy?
It's the classic good news is bad news paradox that we've been stuck in for a while now. You really have to look at it through the lens of the Federal Reserve.
The Fed. It always comes back to the Fed.
It always does. See, the market is completely destined for interest rate cuts. Lower rates mean cheaper borrowing, which fuels growth stocks like SoFi. But the Fed has a mandate to kill inflation.
Right.
If the underlying economy is incredibly solid, which low jobless claims and expanding manufacturing absolutely suggest, it makes it much harder for the Fed to justify cutting interest rates immediately.
Because they can't stimulate an economy that's already running hot.
Exactly. They need the economy to cool down a bit to ensure inflation is dead and buried. When the data comes in hot, the market realizes, oh wait, those rate cuts we wanted, they might be delayed for months. So the market throws a tantrum because the economy is actually too good.
And the source points out that institutions reacted to this specific data by pivoting to a risk-off stance.
Right. That is why you saw that extreme volatility. Big money pulls back from growth stocks when they fear rates will stay higher for longer. That is the roller coaster the source describes perfectly.
Okay, so that explains the red ink. That explains the drop down to $18.97. But the source says, do not let that distract you. Because while everyone was watching the price drop, something else was happening under the hood. The trading volume was massive.
Yeah.
Over 53 million shares traded.
Volume is truth. Price can be manipulated or emotional in the short term, but volume tells you how much conviction is actually behind a move. 53 million shares changing hands is not a quiet exit. It is a battleground.
And here is the nugget from the analysis that really blew my mind. The source specifically highlights power hour. For you listening who might not trade actively, that is the last hour of the trading day. The source says there was significant buying coming in right at the end.
That is a critical detail to focus on.
But why specifically at the end? I mean, if the day was so broadly bad, why buy right before the closing bell?
Think about who buys at the end of the day versus who buys at the beginning. Retail traders, regular folks, people reacting to headlines on their phones, they often buy or panic sell at the open, reacting to the morning news cycle.
Right, they see the red and dump it.
Exactly. But institutions, the smart money, they often wait until the end of the day to settle their positions. They watch the amateur hour chaos, see where the dust settles, and then they make their move.
So if you see significant buying during power hour on a super red day,
It strongly implies that big players are stepping in to scoop up shares while the price is artificially suppressed. They are letting the retail crowd panic sell, and then they are quietly picking up the pieces before the bell rings. It suggests optimism is building behind the scenes. They are looking at that 1897 price tag not with fear, but as a massive discount.
which segues perfectly into the next big point the source makes. It is not just about institutions buying the stock. It is about the company potentially buying itself.
This is where we get into the really fascinating corporate strategy side of things.
Yeah, so the source brings up Upstart. They are another player in the fintech space, somewhat of a peer to SoFi. Upstart recently announced a 100 million share repurchase program. Basically, they are buying back their own stock from the open market.
Which is a massive vote of confidence. A company usually only does that when they believe their stock is significantly undervalued by the public markets. It sends a very clear message to Wall Street: you guys are selling, so we will gladly take it.
And the source looks at SoFi and says, hey, take a hint. The argument is that if SoFi doesn't have a major acquisition lined up in the next 6 months, they absolutely should follow Upstart's lead.
It makes a lot of sense when you look at the balance sheet and their recent history.
Well, let's look at the math the source provides, because this is fascinating financial engineering. They remind us that SoFi's most recent issuance of shares, basically when they sold stock to raise capital, was around the $27 range.
Right, so they sold pieces of the company to the public at $27 a share. They took in that cash.
And now the stock is trading around 19.
If we connect this to the bigger picture, think about what a buyback would mean right now. If you sold something for $27 and you can buy it back for $19, you are effectively engaging in value arbitrage on your own equity.
You are making a profit on your own stock. I mean, it is like selling your car for $27,000 and then buying the exact same car back 6 months later for $19,000. You have the car back, plus an $8,000 difference in your pocket.
Exactly. The source calls it a massive win for the company's treasury. You are essentially retiring shares, taking them off the open market, at a roughly 30% discount to where you literally just sold them. That increases the value of every remaining share for the shareholders because there are fewer slices of the total pie.
It's buying a dollar for 70 cents.
And beyond just the raw math, think about the signal it sends to the market. It tells the short sellers, it tells the institutions, and it tells the retail investors, we know exactly what we are worth, and this current price is wrong.
It is a total flex. It's a power move. And speaking of short sellers, oh boy, does the source have some thoughts on them. This is where the plot really thickens.
This is the battlefield. We have talked macro, we have talked strategy. Now let's get into the tactical warfare on the charts.
The data shows that short sellers currently hold 8.8% of the free float. That equates to about 111 million shares. Now, is that a lot in this context?
It is a very significant position. It means there are 111 million shares that have been borrowed and sold by people betting the price will go down. But here is the major catch. Every single one of those shares must eventually be bought back from the market to close the position.
And the source calls them overextended. What does that actually mean here?
It means the trade is getting too crowded. When you short a stock, you are hoping to buy it back at a lower price. But if the price stops going down, or worse, starts going up, you're trapped. With 111 million shares sold short, if positive news hits, there is a massive amount of buying that physically needs to happen to cover those positions.
That is the squeeze setup. They're sitting on a powder keg right now.
Exactly. And the match that lights it is upward price appreciation.
So let's gamify this chart a bit, because the source lays out the price levels like a video game. Level 1, level 2, boss level. If we're going to squeeze these shorts, Where do we actually need to go?
Okay, so the immediate pivot point to watch today is $19.30. That is the very first hurdle.
1930. Got it.
If the price can reclaim that level, it shows the bulls are taking control of the daily momentum. It essentially stops the bleeding from the Walmart news.
And if we clear that,
Hmm.
the source says we have a ladder of resistance. If we get good GDP data or PCE data, the next targets are 1960 and 1990.
Those are the stepping stones. But the real action, the real drama, happens a bit higher up the chart.
The wake-up zone.
Yes, the $20 to $20.50 range.
Why is this specific 50-cent range so critical? Why does the source say this is where the shorts, quote-unquote, wake up?
Because of psychological and algorithmic thresholds, 20 is a big round number. Markets love round numbers. If the stock smashes through 20 and holds 2050, those shorts who are sitting on 111 million shares suddenly realize their profit cushion is entirely gone. They start going underwater. And when short sellers panic, they don't sell, they buy.
Which drives the price up even faster.
Precisely. That is when you get the explosive upward movement. It becomes a vicious feedback loop. Buying triggers more buying.
And if that explosion happens, what is the ultimate target? The source mentions a holy grail target,
The 200-day moving average.
which is sitting way up at $23.23.
The 200-day moving average is one of the most widely followed indicators for long-term trends. It acts like a giant magnet for the price. The source notes that the market is yearning for a move back to this average. Stocks just have a way of gravitating back to their long-term means. And a move from 19 to 23, that is a very significant percentage gain.
That is huge upside. We are talking over 20%. But, and this is the big but, getting there is the really hard part. And the source acknowledges this directly. They say, I know it is hard to be a long-term investor when the daily price action looks like this roller coaster.
This gets into the psychology of the trade. It is mentally exhausting to watch a stock bleed down on good economic news or just chop sideways for weeks. It feels like you are losing, even if your underlying thesis is completely intact. It's exactly what shakes people out right before the big move actually happens.
The source compares this exact moment to last April. They firmly believe we are on the verge of a breakout similar to what happened then. It is very much that darkest before the dawn vibe.
And to handle that extreme volatility, the source suggests a specific options strategy. And I think this is really worth unpacking for you listening because it is a bit advanced, but it is incredibly powerful.
Yeah, they mentioned selling $19 puts for the week.
Yes, putting your money where your mouth is.
Okay, let's break this down. I know some listeners trade options regularly, but for those who just buy and hold shares, what does it actually mean to sell a $19 put?
Okay, let's simplify it. When you buy a stock, you just pay cash and get the share. When you sell a put option, you are essentially acting like an insurance company for someone else. You are telling the market, I promise to buy SoFi shares at $19 no matter what happens by the end of this week.
Okay, so you are setting a contractual limit order to buy at 19. You are locking yourself in.
Sort of. But here is the real kicker. The market pays you for making that promise. You collect a premium actual cash up front just for agreeing to buy the stock at a price you already think is a great deal.
Wait, so if the stock stays above 19, let's say it rallies to $20, you just keep the cash and do nothing.
Exactly. You keep the premium as pure profit. The option expires worthless, you have no obligation, and you walk away with the cash you were paid on day one.
And if the stock drops below 19, say it goes down to 18.50,
Then you are obligated to buy the shares at 19. You are paying a little above the current market price at that exact moment. But, and this is the key to the whole strategy, remember, the source already thinks 19 is a massive discount. They explicitly said they are more than happy to load up on more shares at that level.
so it is quite literally a win-win scenario for them. Either they get free money for waiting around, or they get to buy the stock they already love at a fundamentally cheap price.
That is the entire logic. It is a way to generate income while you wait for the technical breakout, or to lower your effective cost basis if you do get assigned the shares. It transforms waiting from a passive, painful activity into an active, income-generating one.
That is actually really brilliant. It takes the emotion completely out of it. You have a mathematical plan for both directions.
That is what disciplined investing looks like. It is using the broader market's fear to your own advantage. The market is literally paying you for taking on the volatility.
But for those of us who aren't selling puts, we're just waiting for the catalyst to spark the run. And the source lists a few things that could light the fuse soon.
Right. They mentioned a potential positive shift in student loan policy from the government. Given SoFi's deep background in refinancing, that is always a major lever for them. It is a regulatory wild card that could drop at any moment.
And the cooling of geopolitical tensions. If things in Iran quiet down, the fear trade unwinds, oil stabilizes, and risk assets like SoFi usually just fly.
And let's not forget the core fundamentals. The source keeps coming back to this point. The upside to 23 is simply too good to ignore. The trading volume is there. The buyback potential is absolutely there. The fundamentals are screaming value even while the daily price action is screaming fear.
So, synthesizing everything we've covered today, we have a stock that is beaten down by macro fear. Fed rates, war headlines. It looks really ugly on the surface. But underneath, we have power hour buying, where the smart money is aggressively stepping in. We have a company that is mathematically incentivized to buy back its own shares for 70 cents on the dollar. And we have a massive short squeeze potential if we cross that $20.50 line.
It is the classic conflict between short-term noise and long-term signal. The market is highly inefficient in the short run. It panics. It overreacts to Walmart guidance. But in the long run, it acts as a weighing machine. It eventually has to recognize the value.
The final advice from the source is incredibly simple. Stay patient, stay disciplined. Which, let's be honest, is easily the hardest advice to actually follow in investing. It requires sitting on your hands when your brain is screaming at you to run for the exits.
It is really hard. But that is exactly why looking at the granular data like the power hour volume is so helpful. It anchors you. It reminds you that you aren't the only one seeing the underlying value.
Before we wrap up this deep dive, I want to leave you guys with a specific thought. We talked extensively about that buyback math. The company issued shares at 27. They might buy them back at 19.
A massive value gap.
And we know institutions are buying in the dark, right? At the end of the day during power hour, we see the volume proving it.
Correct.
So here's the question you have to ask yourself. If the company knows its stock is cheap, and the big banks and institutions know the stock is cheap, and they're both buying, who is actually selling?
That is the provocative question, isn't it?
Who is selling to you right now? Is it the panicked retail trader simply reacting to a scary headline on their phone? And when you look back at this chart in 6 months, should you be thanking them for handing you cheap shares?
Or will you be one of the people who panicked and sold to the smart money?
Something to mull over while you watch the ticker today. Do not let the red ink fool you without checking the data first. That is it for this deep dive into the SoFi pivot.
Always a pleasure to look beneath the surface.
We will catch you on the next one. Stay curious, everyone.